Hello guys, this is your modern day spokesman and welcome back to the channel. If you're new, welcome, please feel welcomed, and please don't forget to click on the subscribe button so that you don't miss out on any future videos. Now guys, before we continue, I'd like to thank you for your continued support, your comments, your likes and subscriptions. We are now well over 300 subscribers and we're continuing to grow because of you, because this channel is for you, by me, for you. The content will always be free on the channel. So thank you for that. Now guys, as I promised in part one, I said we're going to be looking at capital gains tax in detail, right? So for this one, we are going to be looking at capital gains from a natural person or an individual person's perspective. A natural person as defined in the Income Tax Act. You can check that out. So the basic framework of capital gains, we are going to assume that the base cost has been calculated correctly. I'm going to deal with base cost calculations in a more detailed video on the last part. So for now, we're going to be looking at the calculation. I did not put dates on these transactions deliberately because I did not want to mislead you when it comes to the valuation date thing, which is going to be dealt in part 3. So for now, let's look at this example. Land was bought for 1.7 million in the previous year of assessment. The owner decided to sell the land in the current year of assessment when she received an offer of 2 million. Some of the things that you can note in this situation is that there is an assessed loss of 16,500 from the previous year of assessment. There was no assessed loss in the current year of assessment. So this is a quick look at our format, the proceeds, what you sold for, what the cost was when you acquired the item, any gain or loss. In this case, there was a gain. The annual exclusion, you less the annual exclusion, which is going to give you a aggregated capital gain. So this is just the basic look. So now let's go and look at our solution. Okay, guys, so now this is the solution for our example as per the 8th schedule. This is the 8th schedule, right? It basically gives us steps on how to calculate the whole calculation and the formula, right? So now the land was sold for 2 million. It was bought for 1.7 million. So if you do that on your calculator, you realize that there was a capital gain of 300,000, right? Now, since we've gotten our capital gain now, we have to go and reduce it by something called an annual exclusion, right? So this only applies to natural persons as defined by the Income Tax Act or special trusts and the likes, but now we are limiting this to natural persons. So the current amount is 40,000, right? So you're going to reduce your capital gain by 40,000, which in turn will give us our aggregate capital gain, which is 260,000, right? So you less this amount by any loss that has been brought forward from the previous year of assessment. In this case, we had a previous loss of 16,500. So we are going to use it to reduce our aggregated capital gain. So if there is a loss in the previous year of assessment, we can use that to offset the current capital gain, right? So this means you're going to pay less tax on your capital gain. Now, this will give us your net capital gain. And also, guys, sorry about that. And also, something that I missed here, right? Since in our current year there was no capital loss, so we would have get capital loss here, and obviously a dash since nothing happened. So yeah, that occurs before the exclusion amount, so it would have been somewhere here. So anyways, the net capital gain in this case, if you do your calculation, will be, we less this amount from this 260, it's going to give us 243,500, right? Now the taxable capital gain, this amount, right? This amount is not taxed fully, right? So in natural person's point of view, we only 40% is taxable. So this is 40% times the amount. So this is actually the amount that will be included in your income tax framework, right? It's this amount of 97,400 would be included. That 94,400 would be included here on your sorry yeah, you would add it here on your taxable capital gain, right? If you were doing an income tax framework, because capital gain tax is not a separate tax, right? So this is where you would have that amount. So you can check out the SARS website to check on this what do you call this exclusion amount, if it has changed, assuming that you're going to be watching this video maybe 2-3 years from now. Can change, can be more, or could be less. But there's also something that you need to know, right? In the year of assessment in which, unfortunately, in the year of your death, right, in that assessment year, your annual exclusion is reduced by 300,000 and not the 40,000, right? So yeah. So this is it, guys. If you have any questions, please don't hesitate to ask. Just leave a comment on the comment section. Don't forget to subscribe if you haven't subscribed. So on part 3, guys, we're going to be looking at the base cost and the comprehensive exam standard example. Yeah, so until then, nda.